Hey everybody, welcome to our weekly Wednesday webcast. Today we're going to talk about different sources of capital for your startup. So first of all, we're going to talk about an IPO, ICO, and gold. Yes, we're going to talk about gold today. So before we get started on that IPO, I want to go do some remedial work and lay the framework for what you would do if you were going to raise capital for your company. So first and foremost, you would start with friends and family money. This is exactly what it sounds like. This is money from your friends and your family, and of course you would use your own money as well. And then next you would go to angel investors. This could be an individual angel investor, an angel investor group, or an actual micro fund of angel investors that are pulling their money together. And then next you would go to a Series A, a Series B, a Series C, and so on. And then generally you would do an IPO. So just to lay the groundwork, I had a lot of questions about the Spotify direct IPO. And people were asking me, what is the direct IPO? It sounds super easy. And it is super easy because you're not involving an intermediary. Now, an intermediary can be a broker, an investment banker, somebody who's actually helping you with the initial public offering. So they are doing what's called the book running, the syndicate, the roadshow. They're pricing the IPO and telling you what price you should price it at. And they're pretty much overseeing this. So I think I've mentioned before in a blog post, but I'll tell you guys again, for those of you who don't read every single blog post that I write, about 35% of M&A, mergers and acquisitions, actually use an intermediary, a broker-dealer or investment banker. So there is definitely a trend of startups just doing it themselves, so to speak, right? So they are just going ahead and figuring out which company they want to acquire, and they're just directly reaching out to that CEO, and they're using an attorney, of course, and they're getting those deals done. So it is true, Spotify did not use an intermediary. It is true, they did a direct IPO, which is exactly what it sounds like. You go directly to the market on your own. But do I think that is a good option for somebody who's at the Series Seed or the Series A level? Absolutely not. And here's why. When you do an IPO, you're actually selling to individual investors who are not accredited and they are not sophisticated. So the SEC back in 1920 created the different standards for what an accredited investor is. So I will go ahead and post those right there if you're curious. An accredited investor basically is a check to say that this person can financially handle this type of investment. But I think the problem with IPOs and when you're actually selling to the general market is that you could have people who are not accredited investors, and more importantly, they're not a sophisticated investor. So a sophisticated investor is somebody who understands how startups work. Now, in portfolio management speak, if you are investing in startups, you should know as an investor that this is an alternative investment. This should be no more than 10% of your portfolio. So if you have people who are getting into your pre-seed or your seed round and they're not accredited and they are not sophisticated, they're going to cause you lots of problems. So I always say this, but I'm going to say it again. If you do your seed round right, your A round will be easy. So never forget that. You do not want to do a seed round with investors who are not accredited, because you can do that now. There's different ways you can do that, but you don't want to do that for lots of different reasons. You don't want an investor who is not accredited, and you do not want investors who are not sophisticated. And when you do an IPO, you actually get both of those. When you do an IPO, you are selling to the general public. The person who's the clerk at the convenience store is actually your investor now. So what we have done in this industry is we've created what are called sell-side analysts, Wall Street analysts, and their job is to track publicly traded companies, so companies who have IPO'd. And what their job to do is to scrutinize these companies to protect the individual investor. Now, they are rewarded when they can figure out which companies are going to tank. So you're either going to get a buy, a sell, or a hold. So if a company has a hold or a sell, that's a warning sign that people should sell or just hold, not do anything with your company. So you can imagine as a CEO of a publicly traded company how much pressure you're under. So if you are a young company and you're trying to grow and you're trying to innovate and you're trying to test things out, it would be miserable to be a publicly traded company. And I've actually watched startups file for an IPO, go out on the market, and actually flop. It's not a good idea to take your company on a traditional IPO or even a direct IPO if you are still growing. I think IPOs are great if you are a mature company. Now, a mature company has worked out all of its kinks and knows exactly what they're going to be doing for the next 3, 4, 5 years, because remember, the sell-side analysts, the Wall Street analysts will be tracking you. So lots of questions about the direct IPO because Spotify just announced that. If you want to go check that out, I'll put a link below so you can look at it yourself. Very interesting. I would check out the S1 if I were you. Lots of interesting tidbits in there, but I would not put a direct IPO on your roadmap. It's just not something for an early stage company. Once you've done a C and a D and an E, and you're fairly established and you're mature and you're not going to be doing much innovation, then perhaps an IPO is good for you. So let's go ahead and bounce over to the ICO. Again, lots of stuff going on in the news with the ICO. You probably saw that the SEC, which is our Security Exchange Commission, had subpoenaed lots of different ICO funds. So I think an ICO is very similar to crowdfunding. 10 years ago, crowdfunding was very, very new. People were very excited about it. People were just kind of piling into it. And just like ICOs, a lot of these crowdfunding campaigns did not pan out, right? So we even had lawsuits, we had bankruptcies. People who donated to certain crowdfunding campaigns said, hey, wait a second, I gave you my $75, I want my gadget. And the person who was sponsoring this crowdfunding campaign could not produce the gadget, so therefore he was sued and he had to file for personal bankruptcy. So I think the ICO market is exactly the same. There's a very small percentage of people who should be doing crowdfunding. There's a very small percentage of people who should be doing ICOs, and it's probably not you. Very similar to an IPO, it's probably not something that you're going to do. So now that we understand what an IPO is, and you understand that it really has more to do with how mature your company is. If you're a young company, you do not want to do a direct IPO or a traditional IPO. ICOs are really the same thing. The subpoena that just came out from the SEC is proof that there is no regulation so far. So we're in the very early stages of the ICO. We do not know how it's going to be regulated. We don't know how it's going to pan out. So if you're looking at the ICO as easy money, which I've seen a lot of people call it that, you're completely wrong about that. I think if you do your seed round right, your A will be easy. If you start off doing an ICO, I think you're just really creating more legal expense because you're going to have a lot of attorneys to back you up on that. As we're seeing right now with the SEC, they are coming down on people who are doing ICOs. It's not the wild, wild west. It will be regulated. So an ICO is basically another security. So just as I mentioned before, in the 1920s, during our last fiasco, the SEC created the accredited investor rule to make sure that people who were investing in startups or privately traded companies actually were able to withstand the losses that they were more than likely going to have. So be really careful when you look at easy money. There is no easy money. There is no really raise capital quick. And why would you even want to raise capital quick? If you really think about it, if you are building a company, you want investors who are going to help you. You want investors who are not just going to give you capital. You can get capital anywhere. Any person who has money can hand you some money. But what you really want is somebody who understands your business, who has domain expertise, who has contacts, who knows other investors, who knows customers, who knows your industry, who's been around for 10, 15, even 20 years, and even more than that, who can actually help you understand what pitfalls are going to be in front of you. That's what you want. You do not want easy money. You don't want ICO money. You don't want an IPO because that's essentially saying that your clerk at your convenience store is going to be your investor. You want smart, savvy, sophisticated investors. That's what you're looking for. So a sophisticated investor is somebody who understands how startups work, and more importantly, they understand how your industry works, and even more importantly than that, how your company works. So now that we understand the IPO is not a good option for you, ICO is not a good option for you, you still have gold. Yes, gold. And what do I mean by gold? Your customers' revenue. I believe that raising money from your customers is the best money that you're ever going to raise. Because if you are building a company and nobody wants to give you money, that's a sign that you have to stop building that company. There are some instances, and we talk a lot about ad revenue, ad-based models here. Also pharmaceuticals. If you're developing pharmaceuticals, no, you're not going to get money right away. Most pharmaceutical companies, they will raise $100 up to $1 billion developing the pharmaceutical, going through clinical trials, going through testing, and then eventually getting it on the market. So if you're doing an ad-based model, if you're doing pharmaceuticals, perhaps you're not going to get revenue right out of the gate. But for most of us, if you're doing something in SaaS or e-commerce or some kind of marketplace or even brick and mortar, you should be getting money right away. If you're putting out a product or a service and nobody is paying for it, that is a sign that there's something wrong with that product or service. So hopefully you understand your customer avatar, you know exactly what these people are looking for, what they want, and you're communicating with them. I cannot stress this enough. Communicate with your customers. Understand why they're not paying. Understand why they're not converting. Understand why they don't want to give you money for this beautiful product that you created. So that is going to give you lots of insight. And again, when you get your customers' money, that is gold. It's absolute gold, because if you focus on that capital source number 3, which is the gold, the customer revenue, and you build a sustainable company, then all those other things become so much easier. Getting a VC becomes easier. IPOing becomes easier. If you want to do an ICO, who knows, 5 years down the road, maybe they make more sense as they're regulated and everyone knows what to look for. But for right now, I would not look for creative financing. I would not look for easy money. I would look for customer revenue, because customer revenue is an indication that you're onto something. So if you can just focus on that, understanding your customer avatar, understanding your growth equation, and we talked about that last week. I'll leave a link below if you don't know what that is. Understanding your sales funnel, understanding your key salient 6 metrics. That's your revenue, cost of revenue, R&D, SG&A, operating income, operating loss, and your cash and inventory if you have inventory. Understanding those key fundamentals and understanding why customers are actually buying, why they're giving you money, is way, way, way more important to you right now at this stage of the game. As you develop further down the road, your 5-year-old company, a 7-year-old company, then you want to start taking in things like venture debt, which we talked about last week. Then maybe you want to do an IPO, which also we talked about last week. So keep it really simple as you are looking at capital sources for your company. Don't get fancy. Just focus on building something that people want. And sometimes we try that and it doesn't always work the way we want it to. So we, of course, pivot, so to speak, right? So you can pivot your company. You can take your company in a totally different direction. I tend to see companies do well when they're actually solving a problem that they understand. I've been advising startups for the past 11 years, and the best companies, I would say, have been companies who were minding their own business. They came across a problem in their own personal lives, at work or in their personal life, and they decided to solve that problem. And then that's how their product or service came about. It's the best way to start a company, because you understand the pain point. And again, it's really important to understand your customer avatar. So if you are the customer avatar, then you understand what motivates you, why you would or would not want to buy this product or service. So again, really focus on your fundamentals, your growth equation, your customer avatar, your revenue assumptions, your expense assumptions, how to get to that salient 6. And in building a company that way is going to attract a lot more investors, a lot more capital. It's going to make you a candidate for a strong IPO. It's a better way to go than just kind of quickly going for that quick money. A good company to check out is MyFitnessPal. They did a really, really great job of just building a company that people liked, and they attracted revenue, and they were able to go on for 8, 10 years. Lynda.com is another one. That took them a long time before they raised outside capital. So there are lots and lots of examples of companies who have built a company, built a product or service that people wanted, got money that way through the customer, even through ads, and they didn't have to raise outside capital. And when you don't raise outside capital, you are able to hold a higher percentage of your company, which we also saw last week. So that is really the name of the game. I wish I can give you some really quick fix, get rich quick, or get capital really quick. Do a direct IPO next week, or go get some money from ICO. It's really not a smart way to do it. I would say the best way to get rich quick is to get rich slow. It's to focus on your customers, focus on building a product or service that people actually want to pay money for. And if they're not paying money, find out why, and continue to just keep reiterating on that idea until you get it right. So I'll go ahead and wrap up today. So just to recap for you guys, we talked about IPOs, direct IPOs to be specific. ICOs, well, I think they're a little bit dangerous right now. Maybe we're in 2018 right now. Maybe in 2 years there'll be more regulations will be solidified, and maybe they won't be as risky. And then last but not least, gold. Your customer's revenue is gold. So if you have any questions for me, you guys, about how to do a growth avatar, customer avatar, a growth equation, or I guess a growth avatar, that's a new word. Your revenue assumptions, your expense assumptions, your financial model, your pitch deck, anything that you're working on, I'll give you my email address. It's just my first name, which is super easy, Lili @financeforentrepreneurs.co. Shoot me an email. I answer every single relevant email I get. If you send me a sales pitch, there's somebody who monitors my emails and they delete all those things. So don't send me a sales pitch that you want me to buy something. But if you have a legitimate question about anything I talk about at Weekly Wednesday Webcast, anything from Founders Masterclass, anything from 30 Days of Mentoring, shoot me an email. I answer all my emails personally within 24 hours. And if you want to join Founders Masterclass, I will leave a link below. It is open 24/7 like a convenience store. We also have something called 30 Days of Mentoring, which is only open 4 times per year, March 15th, June 15th, September 15th, and January 15th. So we are now open. I will leave a link below. The March 15th cohort will close on March 15th. The doors are open currently. If you want to join for that, join me for that. Or if you just have a question after watching this video, just shoot me an email. I answer every single question I get, so you don't even have to be a student in Founders Masterclass. I love hearing from entrepreneurs. This is what motivates me to make more content, whether it's a blog post or a video or an online course. So if you have any question, send it my way. To give you a little history lesson, the first course I ever created was because I was doing a workshop somewhere in person, and somebody asked me whether it was going to be recorded or not. And I said, actually, no, it's not going to be recorded. And she said, well, why don't you record it and put it on Udemy? And that's the first class was Lean Finance for Startups, which was my pitch, my slides basically of that presentation and me talking through them. So, and from there, we had people asking questions about that content, and I just kept building more and more content based on the question. So if you have a question, if anything I'm talking about is confusing, or if you're reading something in the news and you want to know more about it, go ahead and shoot me an email, lily@financeforentrepreneurs.co, and you never know, your question might become part of the next weekly Wednesday webcast or one of my online courses. So thanks for stopping by. It's always a great time to chat with you guys, and I look forward to seeing you next week. All right, bye for now.